DMart did almost everything right. Sales went up, profit went up, stores went up, the business kept growing, and still the stock did not make investor as rich as they expected. That is where the real shock begins, because this is not any story of a bad business. This is the story of a great company that still disappointed many shareholders. And if you do not understand why this happened, you will keep repeating the same mistake in the stock market again and again. Now, the real question, why did such a strong business not created equally strong stock returns? Now, here is the real answer, and this is where most retail investors get trapped. In the stock market, a good business and a good stock return are not the same thing. They can move together, but they do not have to, because a stock does not rise only when a company performs well. A stock can rise when company performs better than what the market already expected. And in DMart's case, that expectation was already extremely high. Think of it like this. Suppose there is a student in school who is already known as the class topper. If that student scored 95 out of 100, people say, okay, expected. Nobody gets shocked. Nobody claps too much. But if a weak student suddenly scores 85, everybody is surprised. In the stock market, surprise creates excitement, and excitement moves prices. DMart had a problem very few company complain about. The market already expected excellence from it. So when excellence came, the market did not get shocked. And that is the real issue. In financial year 2024, Avenue Supermarts reported the revenue of 49,533 crore and profit after tax was 2695 crore with 365 stores. In 2025, revenue rose to 57,790 crore with a net profit of 2,927 crore. And the store count was 415. So, this is not a poor company, not a weak company. This is not a poor execution. This is not some broken retail story. The company kept moving forward with the best possible way. So, then what actually went wrong for the investors? The answer is clear valuation. Now, don't let the word sound complicated. Valuation simply means how much price people are willing to pay today for any company's earning and future growth. In simple language, how expensive the stock already is. And DMart was never cheap. The market loved DMart very early. Investors saw clean management, discipline expansion, and strong store economics. Customer trust and low cost model that look very hard to beat. So they gave the stock a very expensive price. Even recent references still show DMart as the premium value stock. You can see the PE valuation. Okay, and this is the real heart of entire story. When you buy a stock at very expensive price, you're not just buying today's business, you're also paying in advance for tomorrow's success. So later, when that story actually arrives, the stock may not move much. Why? Because the market had already counted on it. This is exactly what happened with DMart. Investor did not just buy a good company, many of them bought a good company at a price that already assumed years of greatness. Think of a house. If a house is truly worth 70 lakh, but people get overexcited and buy it for 1 cr because they believe that the area will become amazing, then later even if the house goes to 1.2 cr, your returns still feel disappointing. Why? Because your starting price was too high. DMart is that kind of story. The business kept improving, but many shareholders had already paid too much for that improvement. And there is one more thing people miss. DMart is a brilliant retailer, but it is still a retailer. It is not a luxury company. It is not a software company. It is not a business that make huge profit on every item sold. It works on low price, high volume model. That means it wins by selling more, moving goods fast, and controlling cost tightly. In financial year 2025 material, the gross margin was around 14.1%. Gross margin simply means the money left after direct product cost before other expenses. That tells you the business is efficient but not magical. It is not kind of business where profits suddenly explode just because revenue grows. This is very important. A lot of retail investors see revenue rising and they think the stock must fly. But if the business model itself has natural limits on margin, then profit growth will not always look as dramatic as people imagine. Demand is a strong because of discipline, not because of fat margin. That make it very solid business. But it also means the stock cannot keep behaving like fantasy forever. This is important to keep in mind. Then comes the emotional shift. Earlier, DMart felt like a dream. It looked like the perfect organized retail story. Fresh, clean, exciting, almost untouchable. That excitement gave a stock a premium. But over time, market stopped seeing DMart as a discovery and start seeing it as a steady compounder. Now that sounds positive and it is positive for the business. But for the stock, it changes the model completely and the mood completely. Discovery get obsession, steady gets respect, stock move harder on obsession than respect. And then competition entered the conversation more aggressively, not because demand suddenly became bad, but because investor started asking tougher questions. What about Reliance Retail? What about quick commerce? What happened if more consumer want delivery instead of visiting store? The company is still strong, but once this question start rising, investor became more cautious. And when stock is already expensive, cautious alone is not enough to slow it down. It does not even need terrible news. It just needs less excitement. So here is the real conclusion, and this is the line people should remember. Demand did not disappoint as a business. Investors disappointed themselves by paying too much for certainty. The company kept doing its job. Sales rose, profit rose, stores rose, but the stock had already celebrated that future too early. That is why a great company can still give you an average return if you buy it at the wrong price. And that is one of the hardest lessons in investing. Business quality matters, but entry price matters just as much. Demand did its job, overvaluation killed the thrill.